the final accounts of a sole trader. Okay, so a sole trader is also known as the sole proprietor. Okay, that's a business that is owned by an individual. Okay, so now the final account of the sole trader comprises of, first one is the trading account. Second one is the profit or loss account. While the third one is what we call the balance sheet. Okay? So the trading account, the profit or loss account, and what? The balance sheet. Now we're going to see them one after the other in isolation. Now the first one, which is a trading account, or recently the name has changed. That's merging the trading and the profit or loss account. It is formally called an income statement or the statement of comprehensive income. Okay, so in case you're seeing that in your exams, you should also know it means the same thing. Okay, now the first one, which is the trading account. The trading account. And the trading account is prepared to get the gross profit or the gross loss. That is the essence of preparing trading account. To get what we call what? The gross profit or what? The gross loss. Okay? So what and how can they get the gross profit or gross loss? Now the gross profit can be gotten by deducting the cost of goods sold from the sales. So it is sales minus cost of goods sold. Okay, so the essence of preparing trading account is to what? Get our gross profit or what? Gross loss. Okay, now when the sales is more than the cost of goods sold, it is gross profit. But when it is gross loss, it means the what? The cost exceeds the what? The sales. Okay, so in the trading account, the trader I want to see is gross profit, okay, or the gross loss, and it is gotten by deducting the cost of goods sold. Now, it is not the cost of all the goods; it is only the cost of goods as what's sold. Because as business men, they can have some goods in the storehouse that is not what's sold for that particular year. Okay, so the gross profit is one to get the sales and the cost of incurring what expenses in what trying to what to make these sales. That is what cost of goods was sold, and it has what a format. It has a format that we can what follow what suit. Okay, now let's see the format. Now we can see it as format of the trading account. The format of the trading account looks thus. Now, the credit side, we can have our sales. Okay, so now at this side, now what normally starts our trading account is what? Opening stock. So I'll have to explain all this one after the other. So our opening stock. Another is the add purchases. Another is the add carriage inwards. Another is less return outward. Another is less goods withdrawn for own use. Now, whatever you have here will not be what we call cost of goods available for sale. The cost of goods that is available for sale. Now, when you now less closing stock, have here now is what we now call cost of goods sold. Okay? Now this is what we're talking about, the cost of goods sold and the sales. Now, at the right hand side, what we can deduct from the sales is what we call less return inwards. I will explain the meaning of all these terms one after the other. So I have less return inwards. So this can give us what we call net sales. So we look for the difference between this and the cost of goods sold. If this part is greater than this, we'll have our gross profit at this point, so that it can balance automatically. So this also should have the same value as this. But if the cost of goods sold is greater than this, what we'll have here is what we call gross loss, so that it can balance also automatically. Okay? Now, all these items, now starting from the first one, opening stock. What does opening stock means? Now the opening stock is the stock that is available in a warehouse or in the store at the beginning of the year. Okay? Probably at 1st January of a particular year, the stock in the warehouse is called the what? Opening what? Stock. That's the stock they use in what? Opening the year. Okay? For that business. So we said it's normally added to what? The purchases. Now what is purchases? Goods bought for resale. Okay, because once you start up a business for a particular year, probably a new year, and you bring out your goods for that was from the previous year, so definitely that goods will not be enough to run out for that particular year. So you have to go to the market to restock, to buy more. So that's going to the market to buy more is what we call what? Purchases. It's called goods bought for what? Resale. Okay. So once you add it to this, now this is carriage inward. Now what does carriage inward mean? Now it means that the expenses or the cost you incurred in getting those goods you purchase in the market, those are the costs incurred in getting those goods towards your store. For instance, probably you went to the market to get some goods and you couldn't, it is so much, you can't take it on your head to get to your store. Definitely you have to call a taxi or get a lorry or something to get those goods to the store. So that cost you have to pay either the bike man or the taxi man or the cab man to take those goods to the store. It is what we call the carriage inwards. Okay, it is carriage inward going to your store. Now another one is less return outward. Now what is return outward? Now probably you've gone into your store and you notice that there are some goods that are damaged or they are not in the right order that you purchased them. You did not see them while you were buying them. So you found that in your store. You have to take it back to the supplier, those you bought it from. So it is called return outward. You are returning it out from your store. Okay, so it's called return outward. So that is why we have to less it. Okay, since we are not making use of it, we have to less it so that we know the actual item that is in the store. So another one is less goods withdrawn for own use. Most time, probably you purchase let me use clothing for instance. You went to the market, you did in clothing, you purchase a particular type of cloth or a jean, and you like that particular jean. You want to use it for yourself. Okay, most time it happens. So when it happens, you less it. That is less goods withdrawn for own use. Okay, so less that. So what we have here is what we call the cost of goods available. Now this is what is now available to sell. Okay, so you less closing stock from it. Now what is closing stock? Remember we have opening stock here. Now what is closing stock? Now closing stock is what? The stock remaining at the end of the year. Probably at 31st December, that stock remaining in the store is called closing stock. Okay, so you less closing stock from cost of goods available. So what will be remaining there are cost of goods sold. The cost of goods will actually sold to the what? To the consumers. Okay, so and here we have our sales. You know sales now. Sales are items that what are sold. Okay, to the what? To the customers. Okay, so the sales. Now the left return inwards, you are lessening from it. The return inward, you are lessening from it. Now return inwards are items that are returned back to you from the customer. For instance, I would say sales, those items what you sold, okay? You sold to customers, and probably you got to the house, the item you sold to them has been damaged. They have to return it back to you. That is inwards. So we have to lessen. The same way you found out that there are some item that was bad, and you return it back to the supplier. That is the same way some customer that bought from you, they might find out that some item you sold to them were bad. They can return it back to you. So it is called return inwards. Okay. Another name for return inwards can also be sales return. So in case you see that in your exams, it's also known as sales return. While another name for return outward is purchases returns. Okay, so just know these two names. Okay, so what we have is what we call the net sales. So this amount here minus the cost of goods sold, whichever is greater. If what we have here is greater than this, it means to ensure that we have the same balance, because in accounting we should have the same balance. So if what we have here, the net sales, is greater than the cost of goods sold, it means to balance it all, we have to get the difference. So the difference is now what we call gross profit. Okay, so that we balance it up, it has the same word balance. But if the cost of goods sold is greater than the net sales, it means that this will be our totals. Then to balance it up now, this should now be what? Gross loss. Okay, so that is how the format for the trading account looks thus. Okay, so that is how it looks. So you can take a look at it, how it looks. So let's prepare the profit or loss account. Let's see also how it looks like. Okay, let's see the second one. Okay, now we have seen the first one of the final account, which is what? The trading account. Now let's see the profit or loss account. Okay, now the profit or loss account account is prepared to get our net profit or net loss. Okay, you say it's prepared to get what? Net profit or what? Net loss. You prepare to get net profit or what? Net loss. Okay, now how do we get this net profit? Now the net profit is gotten by gross profit plus other income minus expenses. That is the gross profit that was carried down in the trading account. You bring it to the profit or loss account at the right hand side, credit side, then plus other income minus expenses. Now let's see the format. Now also, though most time it is added together to the trading account. Okay. Now, for instance, if we have this, so we have this as our profit or loss account. Profit or loss account. It means we have gross profit brought down. Other income can be discount received. Okay, we can have bad debt recovered. Okay, we can have reduction in provision for bad debt. Reduction in provision for bad debt. Okay, and we can also have profits on sale of assets. Okay, so these are some of the profits. Now, the expenses also might be, we have salaries, we have telephone charges, we have discount allowed, we have bad debt, we have increase in provision for bad debt, we have general expenses, we have postage, we have various type of expenses, okay, depending. So the problem or the need, the idea is to identify, to be able to identify what is expenses in this regard. Okay, so we have many types there. Also have advertising, we have transportation and all that. Okay, so now look up. Now, if the income, this is the income side, and this is the expenses side. If the income is greater than this, we'll have a balance here to balance it up as what we call net profit. But if the expenses is greater than this, we'll have what we call net loss to balance it up. Okay? So it's always assumed that this part is greater, but not in all cases, because making a profit in a business is not certain. You might run at a loss. So if the income side is greater than the expenses, we'll have a balancing figure called the net profit, so that they can balance automatically together. Okay, so that is the second one, the profit or loss. Okay, now let's see the balance sheet. Let's see the balance sheet. Now, the balance sheet is known as statement of financial position. It is prepared to show the balance in the what? In the financial what? Statement. The balance sheet is not an account. It's a statement showing the asset, liabilities, and capital in a well-arranged form. Okay, so balance sheet can be shown as this. So, balance sheet as at 31st December 20XX, depending on the year. So it is normally written as at. Okay, so we'll have this. Now the debit side, on the left hand side, we don't have debit side. Left hand side, we have financed by, I have capital here. Capital, that's the money is starting up the business. Now, another thing that will come here is add net profit. The net profit that was gotten from here, if there was. So, I will say less drawings. Okay. Now we have what we call long-term liabilities. And long-term liability are those amounts owned by that firm that can last for more than 1 year. That's why it's called long-term. And one of it is the debenture. Okay. Now we can also have current liability. And the current liability is what the firm owe to outsider that is within an accounting period, within an accounting year, within 1 year. So some of the items there are creditors. Creditors, we also have accrued expenses. Now what is accrued expenses? Accrued expenses, you will see that more in the adjustment if you have watched the video on adjustment. Accrued expenses are those expenses for which we have enjoyed the services, but our money has not been paid. For instance, rent. If you're living in your hostel, for instance, in your hostel, and you have lived from last year up to this year, and you have not paid for that last year, it is what an accrued expenses. It's an expenses to you, and it's accrued. It means owing. Okay, it means you have not paid. You are still owing that expenses. So that is called is what a current liability. Okay, so that is that. We can also have prepaid income. Prepaid income is also a current liability. Okay, you can also have overdraft, bank overdraft. Prepaid income is when you receive income in advance of rendering of services. Okay, when you receive income in advance. For instance, you are asked to sew if you're a fashion designer and they paid you in advance, you've not done the work. It means you are receiving that income in advance of the services to be rendered. Is what and the prepaid what income is a current liability because the right for the ownership of that money has not come. Okay, so that is some of the items on the left hand. On the right hand, we can have our fixed assets. So we can have costs, we can have depreciation, and net book value. Now the fixed assets are those items that belong to the company that can last long. They can last for more than 1 year. They are permanent in nature. In fact, in order of arrangement of the fixed asset, they are arranged in order of permanency. The ones that can last longer. So the fixed assets can be tangible or intangible. Now, tangible in the sense that you can see it, touch it, and feel it. Why intangible in the sense that you cannot touch it, but it's what in a company. For instance, goodwill is an intangible fixed asset. Okay, what is goodwill? The advantage that a company has over its competitors. Okay, so we have land and building as some of the fixed assets. Then if it has depreciation, you can deduct it to get net book value. Then we have plants and machinery. The cost. Then there's depreciation. Then the net book value. Then we have furniture and fittings. We have cost minus depreciation. We get net book value. Okay, so we have premises. If there's cost, net book value. Then also we can have goodwill. Goodwill does not have depreciation. Okay, since it's not a tangible fixed asset. So you can just have its cost and net book value. Okay, so and add up all this and add up all depreciation, then the value will give us our net book value. The net book value is the actual recent value of the asset after what depreciation has been deducted from the cost. So we can now have another heading as the current asset. Current asset are those items belongs to a company that can be used in one accounting period. Okay, they can't last than the fixed asset. So we can have stock. Now the current asset is arranged in order of least liquidity, the one that can easily be converted to cash. So we have stock, we have debtors. Now the debtors figure, if there is bad debt, you deduct bad debt less bad debt. Then less, if there's provision for bad debt, you also less provision. You less bad debt first before you less provision. So I have less provision for bad and doubtful debt. So if you do that, you bring down the original debtors figure. Okay? So we have another here which can be our cash in hand. So we have our cash at bank, or we can call it bank. Okay. So we also have what we call accrued income. Accrued income are those income in which you have rendered a service but you have not received money. Okay, so we have accrued income, and also we have prepaid expenses. Okay, so these are some of the current assets. So when you add up all this with this one here, you are going to have a value, so that when you have all this also, you are going to have a value that is supposed to what? Balance. Okay, it's supposed to what? Balance automatically. If it doesn't balance, it means in your solution, in your solving, there might have been an error. Okay, so that is how to prepare our balance sheet. Okay, so the land and building are the land of the firm, the plant and machinery, machines that are used in production, furniture, premises, then stock. The stock here is the one, the closing stock, not opening. The closing stock while we were preparing our trading account. Okay, trading account. The debtors, those that bought from you, your customers, might either be owing you cash in hand, cash at bank. Okay, so this is the final account that comprised of trading account, profit or loss, and what? The balance sheet. Okay, now we are going to look at the question, typical question that comprise of trading profit or loss account and balance sheet. But I have to tell you, please watch the adjustments video. Watch that so that you can get an insight on what the adjustment before we start solving. Okay, so watch that. Okay. Okay, now let's solve a question using what we've learned from the trading profit and loss account and balance sheet. Okay, so this question is from 2016/2017 section, the past question. Okay, as this is 101. Now let's see that is the past question I can lay my hands on. So the question said, use the information below to prepare an income statement and a balance sheet. Okay, and this is the trial balance of Beta on 31st December 2016. So we have the debit and the credit, machinery and provision for depreciation. 40,000 is machinery, provision for depreciation is 40,000, purchase and sales, the value, stock at 1st January, the value, bad debt and provision of bad debt, carried inward and returned outwards, debtors and creditors, discount allowed and the receipt, and cash and what? Capital. The totals given is, as I said, the following adjustments are to be taken into consideration. A. Closing stock 5,000, rate prepaid 3,000, rent owed 5,000, additional bad debt to be written off 6,000, provision for bad debt is to stand at 1% of debtors, and depreciate machinery at 10% per annum. So the action is to prepare the income statement. Okay, so the first thing I always advise them to do, and which you've seen in the adjustment in the previous video, is to prepare the adjustment first. Okay, so now let's do the adjustment. Remember, I said in the previous video that everything that is in the adjustment will appear 2 times while you're preparing your final account. Okay, so the owner of this is Beta. So the adjustment. So the first one is just closing stock. Closing stock is 5,000. Okay. Now B is rate prepaid. Now let's check if there's a rate they paid here. There is none. Okay, so we'll just write it there. And even there is rate paid here, what you would have done, since it is prepaid, you less. For prepaid, you less this amount from the amount that has been paid. Okay, so I have rate prepaid, which is how much? 3,000. C, rent owed. Is there anything like rent here? No. I think there's rent that was paid. Would have added this. Owed means accrued, which is addition. Okay, so rent owed, which is how much? 5,000. Okay. So D, we have additional bad debt to be written of 6,000. Now, in this situation, I make instance in the adjustment. When bad debt appears under additional information also, what do? We check here if there is bad debt. Now there is bad debt here, which is 3,000. Okay, so the bad debt here, which is 3,000, they said additional bad debt to be written of 6,000. So we're going to have our bad debt. Bad debt amount is 3,000. Add additional. They say we should add additional bad debt to the rating of 6,000. So I have 6,000, giving us 9,000 as our bad debt figure. Okay, so this 9,000 is what will go to profit or loss as the income statement, while the 6,000 will go to balance sheet. Okay, so that's for D. Now E, they say provision for bad debt is to stand at 1% of debtors. Provision of bad debt is to stand at 1% of debtors. So we are going to do the provision for bad debt. E, provision for bad debt. Okay. Now they said 1% of debtor. Now look at the debtor's figure, 60,000. Now what do we do in this situation? Now look up. In the adjustment I said, if we have a bad debt in the adjustment, you have to deduct the bad debt figure from the debtor's figure first before conducting provision for depreciation. That is only when you have bad debt in the additional information. But if the bad debt is not there, you go ahead and calculate the word provision. Okay? So in this situation, before we calculate the provision, we are going to deduct the debtor's figure. The debtors from the bad debt, which is the debtors is 60,000 minus the bad debt is what? 6,000. Because we want to calculate provision for bad and good debt and not the one that is already bad. This one is already bad. So 60,000 minus 6 will give us 54,000. Okay, so is this 54,000? That's the actual debtors figure now that will calculate this 1% on. So we have 1/100 times 54,000. So we have 540. Okay, now this 540 now is the new provision. This is new. The new provision, because we just recently calculated it. Now, when you've calculated this, you check in the question if there was previously provision of bad debt. Now we have the bad debt and provision of bad debt. Provision of bad debt here is 1,000. This is the old, and the new is 540. Now look up. If the old is 1,000 and the new is 540, it means it decreased. It came down. The old was 1,000. The new one we calculated is what? 540. It means it reduced. So what do? We find a difference. So it will be decreased. So this is 1,000 for the old provision. 1,000. So we'll find the difference. So 540 and 1,000. The difference will give us 460. Now this 460 is what we call decrease in provision of bad debt, because the old was 1,000 and the new calculated was 540. So we're going to get the difference. This difference that we post. So this 460 is what? A decrease, which will go to the credit side of the profit or loss account as income. Okay, so that's 460. Now the last part is depreciate machinery at 10%. So say F, depreciation, % of the machinery. I want the machinery 400,000. So 400,000 over 1. So which will give us 40,000 as our depreciation. Okay, so these are the adjustments. And let's prepare the income statement. So we'll have what we call the statement of comprehensive income. As at the same thing as trading profit or loss account. Okay, so the dates they gave to us, 31st December, as at 31st December 2016. So we have our first item there is always our opening what? Stock. Opening stock. Look at it here, that's 3,000. Now the next thing you said, add purchases. What is the purchases? 39,000. This will give us 42,000. Okay. Now check if there's carriage inwards. So look at it, carriage inward. Now we'll add carriage inwards, which is 2,000. That's 44,000. Check if there's return outward. There's return outward at credit. I'll do less return outward. All this was given in the format, okay? So you should be conversant with the format. That's 3,000. This will give us 41,000. Okay? So the other thing that will come here now is our closing stock. So the closing stock is 5,000. So I have less, and this is the cost of goods available for sale. So our less closing stock will be 5,000. So 41,000 minus 5,000 will give us 36,000. Now this is what called cost of goods sold. Okay? So at the right hand side, we'll have our sales. Now we'll check here if there is sales. Sales is 260,000. Now we'll check if there's return inwards. If there's return inwards, there is none. Okay? So we have our sales as 260,000. Now our sales minus cost of goods sold will give us our gross profit. Okay, so that these two will be the same as 260,000. So our gross profit, it means 260,000 minus 36. It will give us from our calculator as 224,000. Okay, so our gross profit carried down 224,000. So the gross profit carried down, we bring it down here as gross profit brought down 224,000. And this is where the trading account stopped. The profit and loss continues from here. This was what I was trying to explain, that you can join it. Okay? So now we're going to post all the expenses in this part. Now the first one here, we'll check here the expenses. Now we have the rates prepaid, or have rates. It was the adjustment as 3,000. I have rent. In the adjustment as 5,000. Okay. So we have bad debt. Remember we have 3,000 and it said add additional as 9,000. Bad debt is 9,000. Okay. We have depreciation. Depreciation of machinery as 40,000. Okay. I will check again. Discount allowed is here as an expenses. So discount allowed is what? 3,000. While we also have discount received as 5,000. Okay. So we'll check if there are other things we've not recorded. Remember, provision of bad debt, it was a decrease, so it's an income. So I have decrease in provision for bad debt as 460. So we check meticulously if there are other things we have not recorded. So if there is none, so we have, if you add up this, 224,000 plus 5,000 plus 460, we have 229,460. So these two is supposed to have the same balance. So it means we have net profit since the credit side is bigger than the debit side. Okay? So I have 229,460. So the net profit is this minus all debts. So we have the net profit here as 175,460. Okay? That's our net profit, 175,460. So that is what we use to prepare the balance sheet. Now state the balance sheet here. Now let's prepare the balance sheet, which is the statement of financial position. Okay? Now using all these items, now let's start with our left hand side. Now I have the first item, which is always our what? Capital. Now we'll check there. Where's our capital? Okay? Capital is 256,000. 256,000. So the next thing we do is to add net profit. And the net profit is the one we got from our trading profit loss account, now which is 175,460. So if you add up, you have 431,460. Okay. Now I'm supposed to let drawings, but from this question there is no drawings. Okay. So we can move to our current liabilities. Now, current liabilities, let's check our current liability. If there is creditor here, there is creditor as 25,000. Creditor is 25,000. Okay? Now we'll check also. Now let's check in that. Now we check in the additional information. Okay? We have rent owed, which is a current liability. So we have rent owed as 5,000. Okay, so we'll move to the right hand side. The right hand side will have our fixed assets. We'll have cost, depreciation, and net book value. Now let's check if we have a fixed asset, machinery. Okay, machinery. The cost they give us as 400,000. So I have 400,000. Now depreciation. Now watch. We calculated depreciation of 40,000 for the current year, but there was provision for depreciation in the previous year, which is 40. Okay, so our depreciation will be our accumulated, the current one plus the previous, which is the provision for depreciation. Okay, we treated that in the addition in the adjustment, the video you watched. So this 40,000 plus the one we calculated recently will give us 80,000. So 400,000 minus 80,000 will give us 320,000 as our net book what value. Okay, so in this will close. So our net book value. So I think that's the only fixed asset. Now we're going to check our current assets. Current assets. And first I'll have stock. Closing stock is our current asset. Stock as what? 5,000. Okay. While the next one we have prepaid rates. Prepaid rate is essentially as prepaid expenses paid in advance, which is current also 3,000. Okay. We're going to start from up here so that we don't miss any item. That is the one you have to do at each point. We've recorded machinery, purchase and sales, trading account, stock, trading account, bad debt and provision of bad debt. Now this provision of bad debt now, we have to take cognizance of our debtors. Let's record debtors. Our debtors is 60,000. Remember, our debtors is 60,000. But we're going to less our bad debts. Okay? So I have less bad debt. Okay. Now remember the additional bad debt. That is what I'm going to list. Additional bad debt is to be rating of 6,000. Okay. So is this 6,000? We deduct to give us 54,000 before we less our provision. As a less provision for bad debt. Okay. Now look at the provision. The provision is the recent one we calculated. Please not the difference. You only record the difference in the trading and the profit or loss account. But the recent one you calculated is what will go to the balance sheet. So let's roll it for issue of bad debt, which is what? 540. So 50,000 minus 540 will give us 53,460. Okay, so we'll check again if there are other items that is supposed to come to the balance sheet. Cash. We don't record cash. Cash is 80,000. Okay, we'll check if there are other items that is supposed to come. We'll check here again. Okay, I think that is all. Okay, I think that's all. So add this 5,000 plus 3, 8,000 plus 8 plus 8, 88 plus 53,460 will give us 141,460. Okay, 141,460 plus 320,000 will give us 461,460. Okay, so if we add up this also, 43,460 plus 25 plus 5 will give us 461,460. So it balanced automatically. Okay, so that is the balance of the balance sheet. Okay, so that is how to prepare our statement of comprehensive income and the balance sheet with the same thing as trading profit or loss account and balance sheet. Okay, now let's move to the next video.